time today. Thank you.
Thank you.
The Social Credit Party, so Chris Leitch and Amanda Vickers. Or just Chris? Oh, no?
Thank you very much. I think Amanda is going to stay there and leave me to do the heavy lifting.
As of the other submitters, we have 15 minutes with you. Please go ahead.
Firstly, thank you for the opportunity. I just want to elaborate a little on what we had to say in our written submission. Firstly, this bill, in our view, if it's enacted, is yet another attempt by a Labor-led government to inject vigour into flagging equity and debt markets while supposedly offering aid to capital-deficient businesses. In our view, the bill should be focused on what is best for New Zealand and New Zealand businesses wanting to develop, not New Zealand investors or overseas investors. It should be focused on insisting smaller or new innovative New Zealand companies to become bigger, more successful New Zealand companies with the aim of retaining the ownership of those companies in New Zealand. Success for those businesses should see them being retained in New Zealand ownership, not sold off to buyers overseas or overseas private equity groups. In our view, confirming the primacy of investor capital, particularly offshore investor capital, should not be a function of government policy or of legislation. That capital can and should seek its return by taking a stake in established businesses. And that's where the New Zealand Super Fund should be focused also. Emerging businesses, by their very nature, need to be able to minimise costs across all areas, particularly in access to development funds, so that the money they have can be used to source education, expertise, and develop international connections. And that as a first priority, rather than having to be concerned about having those scarce funds siphoned off to pay returns to investors. Raising capital for development funds is not the problem, despite what I've heard since I have been here this afternoon. Because government, through the Reserve Bank, has the capacity to provide all the development finance that's necessary, and it can do that at a service charge only, as the government did in 1936 when it provided a line of credit to the country's developing producer boards in order to develop agricultural and horticultural industries. And that facility endured until the mid-1980s. The funding that was provided did not cost the government or the Reserve Bank or New Zealand taxpayers a single cent. All of you, I'm sure, will be aware of the term quantitative easing, and I'm presuming you'll have seen the report from the Treasury in May this year that indicated that there may be a necessity to consider unconventional measures to stimulate the New Zealand economy. Quantitative easing, of course, is the process by which the central bank, which in this case would be New Zealand's Reserve Bank, creates or manufactures digital money and uses that to purchase securities from financial institutions. The way quantitative easing has worked internationally so far is that the newly created digital money ends up in the hands of financial institutions and therefore benefits the finance sector rather than the productive or public sector. Since the global financial crisis of 2007-2008, central banks in most of the world's developed countries have used quantitative easing extensively. However, New Zealand's central bank has not. To give you an example, the European Central Bank has just announced that it's ramping up its quantitative easing or printing money program to 35 billion euros every month. If you say it quickly, it doesn't sound like a lot, but if you say it slowly, it is 35 billion euros every month. And that's an amount that it had been issuing previously, but had eased in recent times. The Bank of England has created approximately £450 billion since 2009, and America's Federal Reserve over $4.5 trillion in the same period. The Bank of China and the Bank of Japan have also indulged extensively in this money creation process. However, in Japan's case, they have taken a very different approach. And the Japanese central bank is buying Japanese government stock or bonds to the extent that it now holds approximately 50% of Japanese government debt. In other words, the Bank of Japan has funded approximately 50% of Japanese government funding requirements over and above its revenue from taxation, etc. And the Bank of Japan is continuing to purchase that government stock, effectively meaning the Japanese government is funding itself from its own bank. Now, the Treasury report identified quantitative easing as one of the unconventional measures it thought New Zealand would have to look at, and why Treasury thinks this is unconventional, given its widespread use across the rest of the world, one can only surmise. What this means for New Zealand is that the Reserve Bank could create funds for much needed venture capital investment and deploy those funds either directly or via established players into developing businesses. A number of submitters to the Select Committee have already suggested that the $300 million figure encapsulated by this bill is small bickies in comparison to what is really necessary to develop New Zealand innovation on the world stage. Using the capacity of the Reserve Bank at no cost and no risk could see that amount doubled, trebled, or increased even more. Additional legislation to allow this kind of funding to be provided is not required, as there are already provisions within the Public Finance Act and the Reserve Bank Act. The only thing that is required is the political will to make use of these provisions. And on that matter, I just want to refer you to two quotes. The first one is this: "We recognise that lifting New Zealand's productivity performance requires well-functioning capital markets that help high-potential firms to raise funds on their growth journey." And the other one is this: "We also know that strong capital markets are central to any productive and competitive economy to help drive growth, create jobs, and increase incomes." Well, the first quote was from Minister David Parker's introduction of the Venture Capital Bill into the House. The second was from National's finance spokesperson Paul Goldsmith, writing in the New Zealand Herald on the 14th of May 2015 under the heading, "Let's Love Financial Markets."
I'm sure he must have been very good.
Well, there was a lot of love there. So it seems the financial representatives of both major parties are in lockstep in confirming the primacy of the financial markets over and above New Zealand's developing businesses. When those financial markets comprise a portion of overseas investor capital, that situation is compounded by the fact that returns to overseas investors have to be paid for from the scarce overseas exchange generated by the very businesses that required the capital in the first place. And so from those two quotes, it would appear that neither Mr. Parker nor Mr. Goldsmith have ever heard of quantitative easing, nor understand the ease with which that digital money could be created by a central bank.
That's okay. Just check.
And I'd love to be proved wrong. One other conclusion, of course, that you could come to, and I wouldn't necessarily suggest it, but one could think it, that they are not recommending that kind of quantitative easing because donations from the financial industry are crucial to funding election campaigns. However, neither reason is a justification for not providing sufficient venture capital for New Zealand's developing innovative companies, or for making them pay for that capital at a significantly higher cost than they need to. Other technical issues relevant to the bill have been well covered by other submitters, particularly the submission that I read from Steve Outram. And in conclusion, we did, of course, provide internationally sourced supporting material with our initial submission.
Thank you. Committee members, do we have any questions for Mr. Leitch? No, but thank you for,
Really interesting.
and thank you for the additional material you've included with it. That's quite useful to us. Thank you. And thank you for your time today. Thank you.